In 2026, it's possible to drive a nice car, post it on Instagram, and still be completely broke. The average payment has quietly climbed into the $700 to $800 range, and that's before you add insurance, maintenance, and everything else, silently draining your bank account each month. This video isn't just about cars, it's about the trade you're making every time you sign for a shiny new ride and lock yourself into years of payments that cost way more than the sticker price ever admits. In 2026, what used to be a luxury payment has quietly become normal. Recent data shows the average new car payment has climbed to around the mid $700 per month, with many buyers well over $800 once taxes and fees are included. Behind that number are record vehicle prices in the $40,000 to $50,000 range, longer loan terms stretching close to 6 years or more, and a culture where almost everyone finances instead of saving and paying cash. On the surface, it looks manageable, just another monthly bill. But this is the starting point of a financial commitment that quietly reshapes everything else in a person's budget. Even when the monthly payment looks okay, interest is where the real cost hides. By late 2025 and into 2026, typical new car loan rates sit in the mid-single digits, while used car loans often reach double-digit APRs, especially for buyers with weaker credit. Over a 72-month term, that means paying thousands, even tens of thousands in interest on top of the car's sticker price, turning a $35,000 car into something that behaves like a $45,000 to $50,000 purchase over time. Rate cuts offer only partial relief because many buyers are still pushed into longer terms just to make the payment work, locking them into years of interest for the illusion of affordability. Most people fixate on the car payment and forget that owning a car comes with a second hidden payment every month. Studies in 2025 found that Americans pay roughly $6,800 to $7,000 a year in extra costs like insurance, gas, maintenance, registration, and fees. That's about $575 a month on top of the loan. Oil changes, new tires, unexpected repairs, rising insurance premiums, parking, and tolls don't show up in the dealership office, but they quietly pull cash away from savings and investing every single month. When you add that hidden $575 to a $700 plus car payment, you're often looking at well over $1,200 a month going into an asset that loses value every year. Depreciation is the cost almost nobody feels day to day, but it may be the most expensive part of driving a newer finance car. Many vehicles lose around 20 to 30% of their value in the first year, and roughly half their value within about 5 years, which means thousands of dollars evaporate just because time passes and the odometer climbs. While you're making fixed payments based on the original price plus interest, the car's market value is racing downward, often leaving you underwater, which means owing more on the loan than the car is worth. That's how people get trapped rolling negative equity from one car into the next, stacking old debt on top of new, and turning what should be transportation into a long-term wealth drain. A big car payment doesn't just cost money, it reshapes an entire lifestyle. When $700 to $800 a month is locked into a vehicle, plus hundreds more in insurance and other costs, there's less room for investing, building an emergency fund, or paying off higher interest debt. On paper, the car looks like a reward for hard work, but in practice it often delays home ownership, keeps credit card balances higher for longer, and forces people to live for payday just to keep the wheels turning. Over 5 to 7 years, that monthly outflow can easily add up to tens of thousands of dollars that could have been compounding in investments instead of disappearing into a rapidly depreciating asset. To make rising prices feel affordable, lenders stretch loans longer and longer, turning what used to be 48 or 60-month terms into 72, 84, or even close to 100 months for some buyers. The payment looks smaller, but the total interest paid explodes, and many people end up with a loan that outlives the best years of the car itself. As the vehicle ages, repairs get more frequent and expensive, yet the monthly payment is still there, creating a squeeze where you're paying both a finance company and a mechanic just to keep the same car on the road. If income drops, an emergency hits, or the car is totaled while you're still upside down, that long-term loan can quickly turn from no big deal into a serious financial setback. Escaping the car payment trap starts with seeing the full picture of what your car is really costing you every month, not just the number on your loan statement. Add up your payment, gas, insurance, an honest monthly average of maintenance and repairs plus parking, tolls, and registration, and say that total out loud so it stops being an abstract expense and becomes a real drain you can point to. Then flip the script. Instead of asking how much the bank will approve, decide what you can actually afford without wrecking your other goals, aiming for your total car cost to stay around 10 to 15% of your take home pay, and even lower if you're trying to build wealth aggressively. For someone bringing home $3,500 a month, that might mean a total car budget of $350, which, after insurance and gas, leaves far less room for a big payment than most dealers will try to sell you. If you're already stuck in an expensive car, there are three realistic paths: keep it and tighten everything else, refinance, or downgrade on purpose. Keeping it makes the most sense only if you're close to an affordable total cost, in which case the move is to aggressively cut around the edges, shopping for cheaper insurance, trimming non-essential subscriptions, or picking up temporary extra income, treating it like a short-term sprint until the balance is much lower. Refinancing can help if your credit has improved since you bought the car. You might lower your rate or payment, but the key is not to treat the new lower payment as found money. Keep paying extra so you shorten the life of the loan instead of stretching it. Downgrading is the hardest on the ego, but often the best for your net worth. Selling or trading into a simpler, reliable used car with a smaller or no payment can instantly free hundreds of dollars per month that you redirect into savings, investing, or debt payoff instead of sending it to a lender. If you haven't bought yet, the power move is to decide your numbers before stepping anywhere near a showroom. Set a hard maximum for your total monthly car costs. Work backward with a calculator to see what price range and loan size actually fit, and commit to shorter terms when possible, even if that means a cheaper car. Sometimes the smartest move is to wait 6 to 12 months, clean up your credit, save a larger down payment, and walk into the deal with leverage instead of desperation. Alongside that, build a car freedom fund, a separate savings account where you automatically send a fixed amount each payday and toss in any bonuses or extra income, using it either to pay off your current car early or to buy your next one with far less or no financing. Underneath all the math, the hardest but most important shift is emotional, letting go of the idea that your car is your identity. A flashy vehicle might impress strangers for 5 seconds, but the stress of a suffocating payment can quietly steal your sleep, limit your choices, and delay everything you say you actually want. When you choose a car that fits your life instead of your image, the payment turns from a weight into just another line in your budget, and the money you free up becomes fuel for the things that really matter to you. Hope you found this video helpful. Thanks for watching, and I'll catch you next time.
Friendly Pavlo inbound. UAV online. Friendly AGM online. We are triumphant.